Oil prices rose again last night, this time over $95 a barrel. Another milestone isn't far off.
Well, I mean, we have a target of $100 a barrel, which was for the end of the year, but it looks increasingly like that'll be exceeded well before that time frame.
It's coming up in our 5 things in 5 minutes. And then in our bonus deep dive interview, ANZ Group's chief economist Richard Yetsenga tells us why the explosion of computing power in AI may not be as deflationary as some think. It may even be inflationary.
The query on an AI-driven algorithm takes roughly 5 times more computing power than a query on a standard internet search engine. I think even with AI, we're going to find there's a big demand for resources, which means, this 3 decades of semiconductor deflation is probably finished.
But first, in 5 and 5 with ANZ, number 1, Brent crude rose through $95 a barrel last night and seems destined for $100. A level not seen since prices spiked to over $120 at the beginning of Russia's invasion of Ukraine in February 2022. Here's ANZ senior commodity strategist Daniel Hines with the reason.
The diesel market has been tight, and we've seen inventories drawn down in major regions across the world, and there's been exacerbated just recently by Russian exports falling quite sharply, partly because Putin's trying to keep more diesel for domestic uses, but also maintenance related plans have also impacted those exports.
Number 2, US Treasury bond yields nudged up to near their record highs this morning ahead of tonight's decision by the Fed. Economists expect the Fed to hold but leave open the option to hike again if inflation doesn't cool off enough. Traders and investors are continuing to price in high rates for longer, a high plateau for rates well into next year. The 2-year US Treasury bond yield rose 3 basis points to 5.09% this morning, just below its 2006 levels. Meanwhile, the 10-year US Treasury bond yield rose 4 basis points to 4.35%. That's a 16-year high. Number 3, the RBA's minutes yesterday showed it decided for a 3rd month running not to hike, but that it considered hiking, which was seen as a hawkish hold. Here's ANZ's head of Australian economics, Adam Boyton, on what it means.
No change to our view that the cash rate is going to sit here at 4.1% for quite some time, although that tightening bias, those concerns about services price inflation do suggest to us anyway that if the bank does anything in the near term, higher interest rates are much more likely than an early start to rate cuts.
Number 4. The central bank in Indonesia, the BI, and the Philippine Central Bank, the BSP, are due to make rates decisions tomorrow. ANZ's Asia economist, Crystal Tan, says they're likely to keep policy rates unchanged.
So Bank Indonesia will want to reiterate its focus on strengthening rupiah stability, but given that both headline and core inflation are expected to remain within the target range, it will not be keen to hike its policy rate. Instead, it will rely on other tools to stabilize the IDR, including market interventions and also other instruments to attract inflows. As for the BSP, the situation is different in that its inflation battle is not over yet. But the recent reacceleration in inflation was driven by supply-side shocks. So we do think that the BSP will want time to gauge the durability of these shocks, as well as government policy measures that were effected recently. However, it will signal a hawkish stance and stress its readiness to act if price pressures intensify.
Number 5. There is some good news on the inflation front in Australia, with consumer expectations of inflation falling below 5% this week for the first time since the war in Ukraine began. Here's ANZ Australia economist Maddie Dunk.
We saw that in the consumer confidence reading this week, inflation expectations declined to 4.9%. And notably, that's the lowest reading that we've seen since February 2022. So before Russia invaded Ukraine, and we saw that global energy prices really soared after that. So it would be very welcome news for the RBA, I think, to see that inflation expectations have fallen below that.
Maddie Dunk there. Now it's time for our bonus deep dive interview. Today, ANZ's Group Chief Economist Richard Yetsenga takes a closer look at what AI might mean for inflation. And it might surprise you.
but I had started getting a few comments that actually technology vendor costs were a bigger issue than wages. Not only were they not falling anymore, but actually the costs over the next 12 months in many ways were rising larger than wages. Then I started to dig in the data, and US semiconductor import prices are rising for the first time since really 1993. But actually the world consumes 10 times more microprocessors than it did, or semiconductors, or let's call them computer chips, 10 times more chips than it did in 1993. And of course, the chips we consume are infinitely more powerful. So the rise in prices now, I think, is a much bigger deal.
You pointed out the growth of AI is actually quite a heavy user of computational power. How does that change things?
Looks to me to be a saturation issue. 86% of the world owns a smartphone now, from about 15 years ago. More than 90% of businesses, according to Gartman, this is businesses around the world, are pursuing a digital-first business strategy or soon plan to. In other words, both of those stats speak to saturation. Certainly there's an upgrade of chips required, but demand, it seems like, has reached a point which is pretty critical. But also, while AI increasingly to me looks like it's a sort of technology that sits beside you, it doesn't replace you. I can use it to enhance my role, but I can't use it to replace economists or analysts that need to be asking smart questions. And in fact, the query on an AI-driven algorithm takes roughly 5 times more computing power than a query on a standard internet search engine. I think even with AI, we're going to find there's a big demand for resources, which means, this 3 decades of semiconductor deflation, it's probably finished.
And that semiconductor deflation was part of the broader story over the last 30 years, until COVID at least, of very low inflation and certainly deflation in goods prices. How do you think it plays into the overall inflation story?
I think you've nailed it, Bernard. It's probably one of the last factors from the pre-pandemic decade which you might have identified as persisting as a deflationary force, but it seems to me not even semiconductors are a deflationary force anymore. And this may sound odd to people. They may be thinking, yes, but semiconductor technology, we're still investing in it. It's very disruptive. Surely that means it's deflationary. I don't think that's the case. If you think historically, and let's take a much longer term view, the whole 100 years of the last century, the most technological advancement in that century compared to any other century in the history of commercial spaceflight, the motor vehicle, even plastics. If you think where we ended the century versus where we started, so much more advanced. But yet, if we take the UK as the poster child, because we have hundreds of years of great economic data out of the UK, in the last century, GDP per capita rose 5 times, but the price level in the UK rose 55 times. Technology is disruptive, but it can't stay permanently deflationary because it starts to draw in resources in and of itself. The global tech sector now employs 3 times as many people as the global auto sector. With the tightness of labour markets everywhere, how can it stay a deflationary force?
And there's also the geopolitical angle here, in that great powers see semiconductors as the new vector for influence. Is that restricting some of the normal forces there?
Well, I think it's probably adding to the inflationary force, to be honest. Maybe we could say semiconductors are the new oil. They're the thing you really need. They're integral to powering your economy. They're integral when you think about your planning for national security and resilience. And of course, they're not quite a zero-sum game, but if I have more chips than you, that probably does give me a bit of an advantage. So unfortunately, in the more complex geopolitical world we're in, we're seeing more competition for semiconductor production between Asia, the US and Europe.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, September the 20th. Catch you tomorrow morning with the latest on the Fed's decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.